Hey, what's going on everybody? Welcome back to the channel. I'm Waller's Wallet, and in this video, we're going to take a look at how using an active account manager to manage your investments may actually be costing you a lot of money. Now, I'm sure this will get some people really worked up, but hear me out and let me explain. Now, if you want a simple way to help out this channel, consider hitting that thumbs up button. Also, don't forget to subscribe to the channel and turn that bell notification on as well so you don't miss out on future videos. Now, trying to beat the market sounds great, right? And making more money, I think, is something that we all want. But what if it's actually easier than you think? Now, in 2020, odds are if you closed your eyes, threw a dart at a board, bought whatever stock it landed on, you made some sort of money. Because in 2020, it just felt like all the market did was just go up. And it just really felt like you couldn't lose. And that made some people crazy amounts of money. But while 2020 was a great year for the stock market, I kept putting my long-term investment money into index funds and ETFs instead of buying individual stocks like Tesla, for example. And while some individual stocks grew at a crazy rate compared to others, index funds and ETFs as a whole had a great year as well. And index funds and ETFs, while they're simple, they have so much going for them. Because when you buy an index fund or an ETF, you're pretty much buying all the companies in that fund. You don't need to worry about finding the best stock to own or any of that extra legwork, because you put your money in these funds and it's split between a lot of different companies, which is great for long-term growth. For example, if you bought VT Sachs, you own companies like Apple and Tesla, Google, Microsoft, and over 3,600 other companies. And having your money split amongst these different companies gives you great diversity, but it also gives you a buffer in case one of these companies doesn't perform well. Because, for example, if Apple has a bad quarter or a bad year, but the rest of the market does well, then those other companies are going to buffer Apple's bad performance. But this is also a double-edged sword, because if an individual stock does really well, you could have made a lot more money. But if that individual stock went down, you could potentially lose a lot of money. And I mean, just look at Tesla. Tesla grew so much in 2020 and absolutely outperformed the market. And index funds and ETFs, they're a great set it and forget it option for investing. And the great thing about these options is that they have historically gone up in value over time because they mirror the market. Now, that's not to say they don't have bad years, because of course the market has bad years, but as a whole, they have gone up in value. And according to Investopedia, the rate after accounting for inflation is on average 7% yearly growth. So while index funds and ETFs may be a boring investment style, it has shown to be a great option that leads to growth for many people. Then the fees on these accounts can be quite small as well, but they will vary depending on the fund. But there are plenty of options from Vanguard with expense ratios of 0.03%, which is extremely cheap. And on average, Vanguard funds have an expense ratio of about 0.1%. So that equates to about $10 in fees for every $10,000 you have with them, which is really not an unreasonable cost to pay. Now, other companies like Schwab or Fidelity have similar funds as well for their companies. But what if? What if you could pay someone to try and beat the market and earn you more money? It'd be worth it, right? Because that's what active account managers attempt to do. They're the pros that manage your portfolio, buy and sell stock or funds to try and outperform the market. Now, I'm all for paying someone who has more experience as long as they can make me more money consistently after accounting for all the fees. Because active account managers tend to have fees in addition to the expense ratios or other fees you may pay for a fund or a stock. Now, these fees are going to vary, and how someone charges these fees to you will be different as well. And that means not only do they need to be able to outperform the market, but they also need to outperform the market well enough that they earn you more money than the fees that you're paying them. But on average, it does look like these fees can add an extra 1% onto you, up to about $1 million you have invested with that person. And then these fees can drop the more money as you hold with those people. So if your fund had a balance of $250,000 at a 1% fee, you would pay an additional $2,500 in addition to any other fees. But are active account managers actually better than passive investing? Now, you would think someone being active and making moves for you to beat the market would do better, but that actually isn't the case most of the time. Now, according to Spiva, who actually looks at actively managed funds against index funds, on average, people who have an active managed account tend to underperform the market not only in the short term, but also in the long term. Now, of course, there will be exceptions to this because there's always exceptions, but as a whole, active account managers don't seem to do as well. And in looking at SPIVA's data for US equities over the last 5 years, active account managers underperform the market anywhere from 11% to about 94%. Now, to be fair, this does mean if 40% of active account managers underperformed, that means 60% either overperformed or equally performed the market. But there was a common trend here. As time went on, active account managers' performance tended to decrease. Now, there were a few places like small cap growth, mid cap growth, and real estate that active account managers outperformed the market over a 5-year span in total, but they still declined over that 5-year period. But beyond these few funds, they didn't. And in year 1 of these 18 funds, active account managers outperformed the market in 7 of 18 funds. That means 11 funds underperformed, or that's 61% of them underperformed. By year 3, that decreased to only 5 funds outperforming their benchmark, while 13 funds underperformed, or that's 72% of them underperformed. And by year 5, only 3 fund categories actively outperformed their benchmark. That means 15 categories underperformed, or about 83% of them. So that means in many cases, active account managers potentially weren't making you as much money than just simple index funds that you can buy yourself. And I actually find this pretty fascinating, that over a 5-year period on average, putting your money in a total market index fund would perform better than having someone do it for you. Now, like I said, there are exceptions to this, and there could very well be account managers out there that do outperform the market, but it doesn't seem to be the norm. So I think this leads to the question, should you be using an active account manager? Now, this will be completely up to you and what you're comfortable with, and I am definitely not saying avoid them at all costs, because this will really be individualized. And who knows? Maybe you find someone who actually outperforms the market consistently. But when looking at the data, it seems in many cases using an active account manager could be giving you a lower return on your money than just a simple index funds, plus you'd be paying more in fees. So if you do decide to use an active account manager for your investments, I would be sure to not only evaluate the fees, but also compare how your return is doing compared to the market. This way, you can see if your account manager is actually outperforming the market. And if they're consistently not doing that, it might be best to change course. Now, I know I'm not a pro when it comes to investing, and I've actually been shifting myself to robo-investing with Wealthfront, who diversifies my money into low-cost ETFs. And they should be able to take advantage of some tax benefits as well to save me some money. So I do pay a 0.25% fee for this, but this should also make my life a little bit easier. And this fee is lower than typical fees you'd pay for an active account manager. But I will have to see how it stacks up to the market at the end of the year to see if I made the same as the market or by chance did better or maybe even worse. At which point I would need to reevaluate. But the more I look at it, the less likely I'm to pay an active account manager to try and outperform the market, because it just doesn't seem to happen often. And in many cases, low-cost index funds or ETFs would give you a better return. So tell me, do you use an active account manager? And if so, do they consistently outperform the market for you? Hey everyone, thanks for tuning in this video. If you want to help support the channel, take a look at the links down in the description below. And if you know somebody that could benefit from this video, feel free to share it with them. And until next time, safe travel and take care.